Good morning, ladies and gentlemen. Well, what an exciting week we've had, and we've got another one coming up. What are the most important pieces of data coming out next week? Well, on Monday, we have the 3-year and 10-year note, and on Tuesday, we have the 30-year note auction in the States. That will keep pressure on US interest rates right up ahead of the all-important Wednesday, when we have the week-defining activity, which will be the Fed meeting and the dot plots that result from the Fed meeting. It will be very exciting simply because we will have not just the interest rate decision, which is a given, that we will have a hike to 0.75, but also the new dot plots, which could have a major impact on the dollar and all other asset classes. So now let us very quickly review the week and show you our predictions for price action for the next week. We will start the review with the price action in the interest rates as always. The quietest week actually has been in the fixed income market, which is not vastly changed. But what is bothering us is that it keeps on hanging around this 187 level in the 5-year note yield, and we are very uneasy that it just cannot manage any kind of retracement down towards the 161 line, where it always has managed to find some support. It is still vastly overbought, and if we change to a weekly view, that will be even more apparent. This level is rightly proving to be pivotal, and the action next week will either way confirm or bust the thesis that we are going higher immediately. The dot plots from the Fed will be very interesting. If they show that we're still on track for at least a 50 basis point hike in interest rates next year, we could have a sharp move upwards again, and really there is no resistance until we get much closer to 230. So that is another 50, almost 50 basis points move in the 5-year note, which would be massive and have very important implications. The 10-year and 30-year are showing much the same. The 10-year on a daily basis is not breaking through the 248 level, but it is again on a weekly basis poised to do so. This is basically the last line of resistance. If we go higher than this, well, we are going to 3. So that is another 50 basis points again. And in the 30-year note, the same thing can be seen. We are now at we've bust through all the downtrend lines, and we have on the weeklies a very, very unstable situation. We will now go either break all the way back down towards the 270 level or go to at least 340. So 30 basis points at least of upside in the 30-year note. These are major moves and major increases in interest rates, which will have very profound effects on the dollar, gold, and to a much lesser extent equities. The European fixed market, on the other hand, is completely different. This is a daily chart of the Schatz, which is the 2-year note, and this is a daily chart of the Bund, which is the 10-year note. As you can see, they are completely different. The last time that the Schatz was trading at this level, the Bund was trading above 168, and it's now trading at 161.5. You can see how much the yield curve has steepened, but that the pivot, the 2-year note, is actually lower in yield. So the yield curve is steepening with a lowering of the front end and and higher rates at the back end. This is completely untenable. It will not last for long. Either the Schatz will have a complete dump, which we think is unlikely while Draghi is maintaining the level of QE that he is, and buying additional short end, having removed the limitations of the minimum yield that he can buy, while the 10-year note is being pressured by the interest rate differential with the US. This situation must worry European fund managers. They know that it's untenable, and they have a big decision ahead of them over the next few months. Do you continue holding overweight positions in fixed income in Europe, or do you now start switching towards equities much more? And we think that they will start switching to equities very, very soon. Any kind of rally towards 164 in the Bund, we think, will be met with a wall of selling from people holding long positions in European fixed income, and we are talking about trillions of euros of those positions. On an absolute yield basis, this is the picture in the Bunds. You can see that we are right on top of the downtrend line, which comes in from 2009. Extremely important level, anywhere between 35 basis points and 40 basis points. If we break that, we are going to 1. So that is going to be a major, we are at a major inflection point in all interest rates. Now, can Draghi control this for a while? Yes, but in the long term, no. We would argue that any move back towards 20 or 15 basis points is going to be a fantastic place to get back in, looking for 1 towards the middle of next year. The current interest rate differential battle going on in fixed income is actually having a very interesting effect on the dollar. We think that we are easily in a fifth wave blowout, and this level of around par has held on the retrace. We could now quite easily see it towards 103, 105 very quickly. Or, on the other hand, it could just break and come all the way back to 96. We are convinced that we are at a very unstable level. It will not stay here at 101.5. It will either go to 105 or back to now 96 in a matter of a couple of weeks. We are quite convinced of that. And naturally, it all depends on what the Fed does. If the Fed now says that interest rate hikes next year are going to be moderate and possibly no more than 1 or 2, we think that the dollar will very quickly give up all these gains and come back towards 96. On the other hand, we are always open to a surprise on the upside and a move very quick move up to 105. In any case, we think it's going to be very volatile, and the decision will be made by Janet Yellen on Wednesday. The market response is going to be very abrupt, we think. Equities have been the major beneficiary of the shift out of fixed income. They are amazingly hugely overbought. We have the daily price bars all outside the Bollinger Bands. We have the RSIs in ES here at 77. The only market which is not hugely overbought and outside all the Bollinger Bands dailies and weeklies is actually the Nasdaq, which has room to make new highs sometime next week. If it fails to do so, it will be a huge tell. We are very, very suspicious of a chart which on a weekly basis looks like that. You can see that throughout history, going back as far back as you like, every time that has been a spike of the weekly Bollinger Bands, the next 1, 2 to 4 weeks have been retracement weeks, coming all the way back to the middle of the Bollinger Band, which at the moment is around the 2160 level. Okay, that might rise up to 2180, 2190, but we certainly think that those levels, if we are in a normal market, will trade again. So we will be very, very worried about further upside in the ES, and we actually think that the higher probability trade is an abrupt trade to the downside as a result of some news. We are in December and anything can happen. The European markets have gone as we thought they would on a weekly basis. Now the objective in the DAX to us is 11,366. That is the level that we see it trading next week at some stage, and where we will take our profits. And the stocks actually has a higher level. We think that without any problem at all, we should manage to trade 3,287 at some stage in the next couple of weeks. You can see how overbought it is outside of all the Bollinger Bands, but this kind of closing break on a weekly basis of this very important 3150 level indicates to us that the market has got a head of steam, that people are going to be buyers of any dip, and that the move out of fixed income and into equities has, especially in Europe, has started in earnest and will continue on any dip in the equity markets. Fundamentally, the S&P has gone bonkers. It has spiked straight through the times 17 Blue Angel, and it is now in basically in the stratosphere. But we would like to show you another chart which we don't normally show you, which is on a monthly basis. This hasn't been updated, it's now up here 2260, but this is the period in history that most worries us and why we are not hugely short. Between 97 and 2000 the market went stratospheric and actually went and touched the 25 times line. Well, the 25 times line is somewhere around 3000 plus. That is, this period of time between 97 and 2000 was completely untradeable. The only thing you could do was to get long of calls or long of puts as a stop and buy the market and just hold it, because it was just absolutely untradeable. The price was moving 3-4% per day for no reason and on no news. We could be going back to that kind of a period, but we would have thought that Janet Yellen would be more than worried by that. So it is a possibility, but we think it's unlikely that the market would want to repeat this kind of error, or that Janet Yellen would like to allow it to do so. And certainly it is in nobody's interest, and certainly not in Trump's interest, to have the S&P at its high on his inauguration and then have it go down 20, 30, 40% over the course of the next 3 to 4 years while he's in office. That is why we think that they will try to jawbone it, or through interest rate action moderate this irrational exuberance which is going on. The sectors are equally nonsensical. Consumer discretionary is trading at certainly at levels where it last traded in 2015. It is not hugely overbought. Does it have a little bit more room? Yes. 2 or 3%? Yes. But consumer staples, which is more bond-like, certainly does have more room on the upside, but that entirely depends on bond yields. Energy is still a complete basket case. Do not get involved with that. It could go anywhere. It could probably can go up to 700, or it can come all the way back down to the lows. Totally nonsensical. But this is the one. These are the ones that actually start, making you sit up and take notice. You've got the financials way through the maximum level that they have been for a good 20 years. You have healthcare at very sensible levels. Therefore, it is nobody's playing defense. Since this is a defensive sector, nobody's playing defense. Everybody's playing offense with XLF, and nobody wants to know about XLV. Might be a mistake. If you want to be long of equities and you want to be slightly defensive, buying XLV at these levels is probably not a huge mistake. The industrials, well, we are just plain bearish as far as the industrials are concerned. We just don't see any upside. Why would they trade through 18 times forward earnings? Are earnings going to be raised so much? Well, we just can't see it. Just because Donald Trump is president, that doesn't mean there's going to be a booming world economy. The industrial sector is an international sector. We just can't see that happening, but we could easily be wrong. Can it go more? Of course it can. The markets always can overshoot, and that is what we're doing at the moment. Can they go up even 3, 4, 5? Yes, they can, but they will trade back to these levels or lower in the quite foreseeable future. The one sector that, if you want to play offense, it still makes sense, it's XLK. Information technology has a lot of room to run, and therefore the safest sector to play it in is this one. If you want to play offense, that is probably our favored sector for offensive, aggressive upside plays. Materials, well, they've done 99% of what they can do. And telecommunications, we still like. We think they still have quite a bit of room to the upside. Given this, we just cannot get really outright long of ES. We can get long of XLV if we're playing defense, and XLK if we're playing offense, and have some telecommunications in the mix, which basically tells us that next week and going forward we will be buyers of NQ if we wish to be aggressive, and sellers of ES if we want to be defensive. We think that one of the major reasons that ES is going up is not because people are buying it. It's also because people are buying it, but it's also because people are just not selling. People are seeing the moves in Europe and in Japan, and they see no reason to sell US equities. That is, it is this mid-December. The markets are going to get thin. People are going to want to put cash to work at any opportunity. Therefore, that is a sensible strategy. If you are hugely long of American equities, well, you're not going to pick this moment to dump them all. You might sort of get rid of the names you least like and raise a tiny little bit of cash if you have been very heavily invested. But you are not going to go to zero equity weighting and 100% cash just because it's through the 17 times Blue Angel. You have to be a very aggressive trader to do that. And we think that European funds are going to increase their allocations to equities. They tend to be quite insular, and they will increase equity allocations domestically. Therefore, again, we would prefer the DAX and the Stocks 50 to the ES going forward into next week. We think they have much more upside because there will be some genuine money flows, aggressive buying, and also because they are so much cheaper than ES. We are talking about single digits to low teens in valuations, as opposed to over 17 times forward earnings for the ES. Our biases for next week basically write themselves. Bunds, still long-term volatility. Either it will break the trend line or it won't, in which case it'll come back to 15 to 20 basis points yield before it goes again. So look to buy long-term puts in the Bund on these spikes. The ES, it is our preferred contract for shorts. We see very little possibility of it going up relative to NQ or to the Russell. European equities we prefer to US equities because we think there's going to be fundamental money flow going out of European fixed income, and that is measured in the trillions. And don't forget that the equity market in Europe is much smaller than the equity markets in the US and far less liquid at times, and therefore any change of allocation between fixed income and equities is going to be far more pronounced in percentage move terms than it would be in the US. TLT, we still think that if it goes all the way back up to 127.50, it's a big time short. So basically, if the market retraces, as we showed you earlier, the preferred position is to be long yields. The 5-year and the 10-year note are at the levels that we said are so crucial, and next week we'll resolve them one way or the other. And in the US dollar, we still maintain that you have to be long of volatility because this market is either going to break through the lows in Euro USD around the 104.5 level and go to 102 and then to par very, very quickly, or it's going to reverse the whole of the Trump rally going back up to 111, 112 in no time whatsoever, depending on what Janet Yellen decides to do. We shall see, but we are quite firm in our convictions. We would absolutely not be buying US equities at these levels, especially in ES, because things that don't make sense one should not chase. Even if we get a repeat of the 97 to 2000 market, we would rather miss it than get absolutely buried, which is what we think people who are buying up here eventually will be. Thank you very much indeed for listening, and we'll be with you the whole of next week tweeting away. Thank you. Bye bye.